Hello and welcome to the NAGDA Legislative Update webinar. I'm Polly Scott, Communications and Deferred Compensation Plan Manager for the Wyoming Retirement System. I'm also NAGDA's past president and the Legislative Committee Chair. I'm pleased to serve as the moderator for today's webinar, and I'm glad that all of you joined us today. Before we get started with the presentation, we want to let you know about a few housekeeping items. First, please remain muted throughout the call so the presentation isn't interrupted. At the end of the presentation, there will be a question and answer period. Throughout the call, you may submit questions through your web console. Simply locate the question and answer panel on the right side of your screen, type your question in the open area, and click Send to submit. The PowerPoint presentation for today's webcast has been posted to the NAGDA website. If you would like a hard copy of the PowerPoint, you can access it on the NAGDA homepage at nagda.org and follow the link in the News and Events section located in the middle of the homepage. Also, before we move into the main part of our presentation today, I want to point you to an interview that NAGDA will be releasing later today. It features me as NAGDA's legislative chair giving an update on some of our legislative priorities, as well as an update on NAGDA's United campaign for National Retirement Security Week, Your Whole Story. NAGDA relies on the support from our industry members to offer the webinars, and our webinar sponsors include AXA, Empower, ICMARC, Invesco, Lincoln Financial Group, Mass Mutual, Nationwide, Prudential, TIAA, VALIC, Voya, and the Siegel Group. We are grateful for the support of these industry sponsors. NAGDA is pleased to offer one continuing education credit for this webinar for INFRE, CRA, and CRC designees, as well as CFP and CPE designees. In order to receive credit, please be sure you are logged into the webinar under your own name. I'd like to welcome our speakers for today's presentation. We have with us Susan White. Susan is president of Susan J. White & Associates, a government relations practice based in Alexandria, Virginia. She serves as legislative counsel to NAGDA. Susan has worked closely with the legislative and executive branches of government in Washington, D.C. for the past 19 years, coordinating government relations strategies with a variety of public and private interest groups. John Shiner is also with us, and John has been involved in government affairs for more than 30 years. He began his career on Capitol Hill in 1969, working extensively on tax matters, health care financing, trade, Social Security, and income security issues. John has also extensive experience with matters before the committees on appropriations, energy and commerce, and financial services, and the corresponding Senate committees. So at this time, I'm going to turn it over to Susan to begin our program.
Thank you, Polly, and good afternoon, everyone. Polly had mentioned the Your Whole Story, which was developed in response to the Senate resolution that we've been working on for many, many years. And in 2016, in the fall, the Senate once again passed Resolution 575, National Retirement Security Week, co-sponsored by Senators Cardin and Senator Enzi. We really appreciate greatly their continued support and co-sponsorship. They are key members on pension and retirement-related issues. We work with them on in a number of areas, and they are on the Senate Committee on Finance. Also, this year, Senators Alexander, Wyden, and Collins, all members of the Senate Finance Committee, co-sponsored the resolution, and we greatly appreciate their support as well. Senators Cardin and Enzi have indicated that they will work with NAGDCA to reintroduce the resolution again later this year. That usually takes place in the fall. so it's likely to happen in September, and we will continue to keep you apprised of those developments. Polly mentioned NAGDA's legislative priorities, which the Legislative Committee and then the NAGDA Board worked to develop this year, and these are the issues that we've taken forward to the administration, the Department of Treasury, as well as to the key policymakers on Capitol Hill in the Senate and on the House in the House of Representatives. They are the National Retirement Security Week, which we just talked about, and then what we like to refer to as governmental defined contribution Roth package, a number of provisions that would NAGDA feels improve the Roth defined contribution plans. So allowing portability by allowing rollovers from Roth IRAs into governmental DC plans, which is not possible now, although governmental DC plan dollars can roll out to Roth IRAs. Additionally, to create more equal treatment by exempting Roth contributions from the RMD rules, and to allow non-spousal beneficiary rollovers into governmental DC plans. Additionally, we're looking to eliminate the first day of the month rule for Section 457 plans. This is something that we've had pending in legislation, but there has not been legislation recently that's passed that is tax-related or pension-related that provision could be a part of. So we are hoping that if tax reform moves forward this year, we have an opportunity to do that, and we're working with a number of members in the House and Senate where they also have their own specific pieces of legislation on that and NAGDA's other priorities. So what is the state of play here in Washington, D.C.? Today, the President's proposed federal fiscal year 2018 budget came out. It makes major cuts in entitlement programs and in the domestic arena, funding arena, program arena. But very interesting development here. Usually when the budget comes out, the Department of Treasury releases something called a Green Book, which details tax proposals. This is where they might have given us more information about their proposals related to tax reform, and there was not such a release today along with the budget. They've indicated there may be more, that there would be more coming in the future. So that is interesting that the administration with its budget has not taken a specific stance at this time. We saw a one-pager come out April 26th on a tax reform from the administration that indicated that they would be looking at corporate and individual tax rate reductions, but that's about all we've seen so far. There is so the time frame on tax reform remains very fluid and very open. It is also very dependent upon something that you've seen a lot recently in the headlines, which is the effort by Congress and the administration to repeal and replace the Affordable Care Act, a major cornerstone of President Obama's administration, as you will remember. That has been winding its way through Congress. Major legislation passed the House of Representatives several weeks back and is pending in the Senate. And because of the way the budget rules are structured, right now they need to pass that legislation before they can move forward with tax reform. And there's been a lot of opposition at the grassroots level to the repeal and replace legislation, so everything is getting pushed back in Congress. The health care legislation is taking longer than anticipated to deal with and to legislate, and so tax reform is getting pushed back as well. We just learned, I want to change the second bullet because things change in Washington overnight, that Secretary Mnuchin, the Secretary of the Department of Treasury, will be testifying before the House Ways and Means Committee, the committee that has jurisdiction over the tax code, this Friday morning, and we will be following that and reporting on developments in terms of what the Secretary has to say about the administration's position going forward. I think it is still an open question regarding who will lead on tax reform or how all of this will play out. The Constitution requires that the House move forward first on tax-related provisions. So it's likely that the House will ultimately do that. I think they're waiting to hear from the administration more publicly. So I think these hearings Friday morning may shed some more light on how they plan to proceed. The Senate Majority Leader, Senator Mitch McConnell, Republican from Kentucky, has said that they will use the process that is called budget reconciliation for tax reform. This is an arcane and complicated budget process. This is what they're using right now for the American Health Care Act, the repeal and replace health care legislation I recently mentioned. And basically, if they're able, so there are a lot of rules around how they can use this process, but they would like to use it for both health reform and tax reform because it would only require a 51-vote majority in the Senate, which the Republicans have and could do. And they would like to be able to do it with all Republican votes and not have to rely on the Democrats. As you can see in Washington right now, things are pretty split politically down the middle. So it'll be interesting to see if they're able to pass the health legislation and then move on, and whether they're ultimately going to be able to do it in a partisan way, or if this process has to become bipartisan along the way at some point. There currently is no federal fiscal year 2018 budget resolution that would allow them to move forward with this budget process, this budget reconciliation process, and a budget resolution sets the blueprint for this process then to move forward. So as you can see, there are a number of sort of technical budget pieces that still have to play out in order for tax reform to move forward. And I mentioned the 51 senators. Most legislation, if it's not part of this budget process, would require 60 votes in the Senate. So this is why they want to do it in this manner. As I mentioned, President Trump introduced on April 26th the one-pager that laid out his tax plan. There was very little detail and nothing on pensions other than that the Department of Treasury has said that the pension deductions would be maintained. And his plan is based around lowering income tax and corporate tax rates. So clearly they will be in a position where they are going to have to find revenue. If they're going to be lowering tax rates, they'll be looking in other areas, and I'll talk about what that could mean for the pension world in a minute. I think, again, we've said the timeline is unknown. There is a bipartisan interest in tax reform. A number of Democrats in leadership have indicated that they would like to sit down and work out tax reform details. An example would be Congressman Richie Neal from Massachusetts, who is the ranking Republican on the House, Democrat, excuse me, on the House Ways and Means Committee. We have met with him, and we're working with his staff. He's working on a bill, but he is also sitting down with the chairman of the House Ways and Means Committee, a Republican, Kevin Brady from Texas. So there are efforts to reach across the aisle and to work out the legislation in a bipartisan way, at least from the Democratic side that we're aware of. We've had indication that there is an interest in including pension-related issues, but it's still not clear what those would be. So what is at risk? What is out there for NAGDA? We kind of divide our issues into two categories: what we have to be concerned about, what we have to be on the defensive about, and the priorities that we've laid out for you earlier in this presentation, that are the things on the offensive that we would like to get have be a part of tax reform legislation. Well, recently a new issue, the ratification of governmental defined contributions plans, has been raised. And we have talked with the key Republican and Democratic staff about this. This is an issue, a subject that got discussed with them during the industry roundtable, the NAGDA industry roundtable. But essentially, it would shift current pre-tax plans to a post-tax arrangement, i.e. Roth plans. And it would save significant federal revenue up front, and that would help pay for the tax cuts that I just mentioned. That is one idea that's been circulating in Washington recently. And we've made it very clear from NAGDA that we have concerns about that. We have concerns about savings, about administrative burdens, about education regarding such a broad change in defined contribution plans. I think it's safe to say that many in Washington are looking at this and have raised concerns. And we are in the process also of conducting a survey and putting together information about how NAGDA's members view Rothification. Rothification is really a new Washington term, but that's what we're calling it. It could, as you can imagine, represent a significant shift in retirement policy. And we have had some of the key policymakers on the Hill acknowledge that issue, and so I think that's in our favor because I think that there are people on both sides of the aisle, members of Congress, that would be concerned about just jumping in to a major shift like that. So what are the other risks, particularly when we're in an environment where there is going to be a need for revenue if they're going to cut tax rates? We've mentioned Rothification. There's the issue of the consolidation of defined contribution plans. This issue has gained less steam among policymakers in the last few years. NAGDA, as well as other groups, have lobbied against the consolidation of defined contribution plans. But that doesn't mean they couldn't come at government-defined contribution plans in other ways. We remain concerned about the loss of the 10% excise tax exemption for Section 457 plans that was contained in an earlier tax reform effort a few years back, and is something that we're watching closely and that NAGDA has taken a position on and indicated how important the 10% excise tax exemption for 457 plans is still in terms of providing incentives for saving, et cetera. Contribution limits, that's always a place that Congress could look if they're indeed needing to find money. Lowering contribution limits, I think, again, that may be less likely right now, but it's certainly on the list. And then ultimately the deletion of the coordination requirements, the provisions that were contained in EGTRA many years ago that would allow the maximum contribution if state or local government had if a participant had a 401k and a 457 or 403b to be able to make those maximum contributions to each plan. So again, that could raise significant revenue to delete that provision. And finally, I would just end with, we're always dealing in things we're hearing here in Washington. I have also just recently heard that there's some discussion about efforts to do something with the Savers Credit, and more specifically, I've heard that people are discussing trying to double the Savers Credit and looking at whether or not it could be determined on an individual's withholding. So with that, I will end and turn this over to John Shiner, who will follow up on some of my remarks and expand on some other issues. Thank you.
Thank you, Susan. I'm going to start off with again, reiterating about tax reform and what President Trump and Secretary Mnuchin and National Economic Council Director Gary Cohn came out with back in April. It would propose lower rates, both for corporate and individuals. For individuals, it was going to propose a higher standard deduction, much higher, almost probably eliminate a great deal of itemization for folks around the country, even if they had significant mortgage interest deductions. It would eliminate all itemized deductions, save the mortgage interest and charity. That would include state and local taxes and business deductions, medical deductions, and so forth. That would be a very dramatic change, needless to say. However, when asked, Secretary Mnuchin said, no, that does not include deductions for contributions to deferred retirement accounts. So he made it quite clear that that when they said they would get rid of all the deductions, they were not including the deductions that actually not part of itemized deductions, but a pre-tax deduction for contributions to retirement accounts. The proposal also has a dramatic change in how pass-through organizations are taxed. Pass-through organizations are partnerships, subchapter S corporations, master limited partnerships, and so forth. These business entities would be taxed at 15%. Now, since then, the Secretary has stepped back a little bit and said, well, for certain, some pass-through organizations will not get that 15% rate because of the great fear that folks would organize their businesses in such a way that almost everybody would be at the 15% rate, and I don't think that's what the Treasury Department, at least at this point, had anticipated. Now, corporate rates would also be lowered. That is, corporations that are incorporated and not pass-throughs, they would also get significantly lowered. And there would be some effort on the international tax side to change the system from what is now existing, what's called a worldwide system, to a territorial system. I'm not going to go into that here. They would also deal with the fact that right now, billions and billions of dollars are sitting abroad in bank accounts for major U.S. corporations who have not returned that money because to return it would mean it would become taxable. There would be some relief for that in order to raise revenue and to bring revenue into the country or bring money back to the country that could be used to improve the economy. Then there's also a very significant part of their proposal and a very significant trade-off, which is being discussed both at Treasury and over in the House, and that is a possible trade-off between interest deductions for corporations and businesses and expensing. Today, most businesses deduct their interest costs, but they itemize significant capital. They rather amortize significant capital expenditures. What this would say was that significant capital expenditures would be immediately expensed, but you wouldn't get an interest deduction. And then finally, not at the Treasury level, but at the House level, Speaker Ryan and Chairman Brady have proposed with great vigor the border adjustment tax. The border adjustment tax, in a nutshell, is that corporations that imported goods would not be able to deduct the cost of those imported goods against their against their income, their gross income. On the other hand, they wouldn't have to include income the amount of income they earned from selling products abroad. In a nutshell, that proposal is being introduced to encourage exports and discourage imports. And needless to say, that's undergoing a great deal of examination by a whole lot of people in this country because, quite frankly, depending on what business you're in and how you consume product would determine how you feel about a border adjustment tax. The indirect impact on retirement savings, I think, is very important to consider. If you lower marginal rates and if you increase the standard deduction, that means that the marginal value of a deduction for savings is going to change significantly for an awful lot of people. So the question is, and we have to raise, would there be a change in the back a slide, please? Okay. Will they lower marginal rates in the absence of tax liabilities lead to more Roth contributions? In other words, people would say, well, my marginal rate is so low, I'm not getting much of a deduction for making a contribution into a standard pre-tax account. I might as well go into a Roth. And maybe in the future, my income will go up and, I may retire with a higher marginal rate, or maybe in the future they'll raise taxes because they won't be able to pay for everything, so I'd be better off doing a Roth. So we don't know what that behavioral change will be, but I think one has to consider that when they do these tax changes. You might call it the unintended consequences. And so I guess we'll be looking at that, although I'm not sure that we'd be lobbying anything on that, but it's something we ought to be aware of. Now, could there be an attempt to alter the rules for deferred retirement savings, as Susan alluded to? The most recent comprehensive attempt to do tax reform, that was by previous Ways and Means Chairman David Camp, included a provision to limit deductible deferral to 1/2 of a taxpayer's total deferral into a retirement account. The remaining portion of their deferral would have to go into a Roth account. By limiting deductions into deductible deferrals and requiring Roth contributions, he created a considerable current revenue impact. In other words, there would be much less money being deducted and much more money being paid in current taxes, even if later on, years later, there will be less revenue collected because distributions from Roth plans are tax exempt. The question you can add to that is, if Congress attempts to pass a revenue neutral package and they don't have offsets that are sufficient to satisfy the collective body of Congress, what will they use to do the offsets? Well, that could mean that deductible deferrals could be in jeopardy. In fact, in the 1986 Tax Act, it wasn't defined contribution plans, but defined benefit plans that saw some haircuts in order to raise revenue to make the bill balance on revenue. Could you have that here? Possibly. So would requiring Roth contributions, now the other question is, would requiring Roth contributions run afoul of the so-called Byrd rule, Senator Byrd rule, for reconciliation bills? That rule says that in the out years, beyond the 10-year window, the proposals cannot cause significant deficits. Well, if we're not collecting taxes on the Roth accounts because they're exempt, will that create deficits, and how will the CBO and the parliamentarian look at that, and whether they would be able to do that? These are right now pretty much unanswerable questions. I want to get a little bit the 10% rule. It's not on my sheets there, but I want to talk a little bit because it was referred to before. NAGDCA's done a little bit of preliminary work on figuring out how the 10% rule plays into this reform. You may recall in the Camp bill, Chairman Camp repealed the exemption from the 10% penalty for 457 plans. Many think that the 10% rule, the 10% exemption creates leakage. Well, we've done a little bit of study with some plans and found that the leakage is very, very small relative to the amount of money that's in the total corpus of any particular plan's savings. So if you look at a plan and see how many millions or even billions of dollars are being saved, and you look at how much is being leaked, that leakage is probably less, in the neighborhood of 1% or less. And most of that leakage is attributable to folks between 50 and 60 years old, many of whom in public service are retiring, not just leaving the job for some other job. So they might well be using that money to supplement their retirement, as was intended for these defined contribution plans. So we're going to be talking about that. I want to talk a little bit about a survey that was done. You might have participated in that survey. And in that survey, about 57% of NAGDA, of the respondents, said that changing the 10% rule would have an adverse effect on the savings activity of members of the plan. And about 43% of those responding said no, it would not have a serious effect. So we will have to do more research on that and see whether, and when we go and look at other plans, to see if it's consistent with our initial findings that the amount of leakage is relatively small. Now to move off the tax bill into the fiduciary rule, a very interesting development occurred the other day. Originally, when the Trump administration came in, they had the Department of Labor delay the start of the fiduciary rule application to June 9th. Yesterday, the new Secretary of Labor announced that he would not extend that delay because he did not have enough justification to do so. So the rule will begin to go into effect on June 9th. Whether there'll be other efforts to delay it through legislation or through lawsuit, I'm not sure. There have been a number of lawsuits, and almost every one of those lawsuits have been found in favor of the rule, in favor of the Department of Labor, but I'm sure they will move their way up through the appeals court, and we'll see what happens. I would say the opposition seems to remain intact as it was before. There was some talk that the 2017 appropriations bill, which is covering this year right now, would include a provision to prevent the rule from going into effect, but as it happened in the negotiations between both parties, it was one of the few bills that's been bipartisan, that effort was dropped, and there was no provision to affect the rule. Recently in the House Financial Services Committee under Chairman Henseling reported out what's called the Choice Bill, which is, for the most part, changes and amendments to the Dodd-Frank legislation that was subsequent to the financial crisis of 2008. The bill was reported out on May 4th, and it requires the SEC, before promulgating any such rules, report to the House Committee on Banking and to see whether there's a need for a rule and what the uniform standards should be for covering transactions. In addition, the SEC's chief economist is required to support his conclusions with an economic basis. And the DOL rule, if there was going to be a DOL rule, it had to conform with the SEC rules. The bill is likely to pass the House, although recent indications from Majority Leader McConnell is that it's unlikely to find time in the Senate this year. And, of course, it would be subject to the 60-vote filibuster rule, and so it would be unlikely to pass, and I imagine that Senator McConnell, Majority Leader McConnell, does not want to take up time on something that is not likely to pass. The major points of contention on the fiduciary rule are that many who would be considered fiduciaries fear lawsuits, especially when investments are unsuccessful, and they're not really comforted by the best interest contract. Many providers of services to small investors do not believe they can continue to provide these services without significant commissions, which they would not be able to charge under these rules, and they believe the rule jeopardizes the use of these commissions and therefore the availability of advice to smaller investors. And that, in fact, has been those two have been the major contentions of the opponents of the fiduciary rule, and I think that's where the issue will be decided on how people feel that are those downsides outweigh the upsides of the fiduciary rule. I'll turn it back to Susan and to Polly Scott right now.
Thank you, John, and also thank you, Susan. We appreciate all the information that you've shared with us today. I want to remind everyone that at the end of the webinar today, we're going to have an evaluation survey, and it only takes 2 minutes to complete, so don't forget about that. We are now going to move into our Q&A time, and I'd like to remind you that you may submit questions through your web console. So simply locate the question and answer panel on the right side of your screen, type in your question in the open area, and click Send to submit. We'll try to answer as many questions as time allows. And as questions are coming in, Susan and John, feel free to share any additional thoughts you may have as you've reflected on the discussion so far and also the new information about the budget that was just received today.
Polly, thank you. This is Susan. I would urge those who are listening and to share some of this information with others and your colleagues, and if you have real concerns about some of the issues we've discussed. As I said, NAGDCA is taking an advocacy position on a number of these concerns, including this new Rothification issue, but I would urge you to write to your members of Congress. I think that has played an important role in how this health care bill has wound its way through Congress, and it always plays an important role on other issues as well, including these.
Thank you, Susan. That's a good point, and we may be able to follow up with that and organize a kind of a template letter for people to use if they would like. Also, I have a question here. Rachel Parker's asking, if we can get copies of the presentation. And the PowerPoint presentation for today's webcast is on NAGDA's website already. And so if you want a hard copy, you can go to the NAGDA homepage at nagda.org and follow the link in the News and Events section located in the middle of the homepage and print it out. Any other questions coming from the audience? If not, I guess I can ask a question that's on my mind. I am rather optimistic that because a vehicle might be moving, that NAGDA may have an opportunity to resolve some longstanding glitches with our program, if you will, such as the first day of the month rule. Susan and John, I know it's hard to speculate, but what are your thoughts there? Do you think that provision could potentially be addressed?
That would be our hope, Holly. It's been a while since we've seen a substantive tax bill. It's been the last one from several years ago did include the changes that we had advocated for to allow for governmental defined contribution plans to offer Roths on the governmental side. So we're hoping that if something moves forward here, there will be opportunities on the first day of the month provision, which we've had indicated support from, and on some of these other NAGDA priorities. And at the same time, of course, as I said, we've always got to be concerned about what they could do to these plans that we would not support either. So we're kind of watching both sides of the track.
Thank you, Susan. I'm not seeing any additional questions coming through, and this is a great opportunity to hear directly from our representatives in Washington, D.C. about what's happening and what the outlook is. So please, don't be shy. Okay, I have a question here from Galen Bath. Hello, Galen. I can't see the whole question.
Holly, I can read it for you if you'd like.
Okay.
The question is, I responded to the survey regarding Rothification. However, it didn't ask how many of our participants use pre-tax over Roth. I think that information would be important when you lobby against it. Would you agree that would be helpful?
Yeah, thank you, Tracy. I can see the question now. I believe the reason we didn't ask that is because we have a lot of that information in the Perspective in Practice survey, and we were just trying not to duplicate questions. But I think that's true, Galen, that by and large, most of our savings is happening pre-tax by far. And if we need that information, then we certainly will issue another survey.
And I would just add, Polly, that certainly is part of our argument to Congress on this issue, and something that we have talked with them about and will continue to do so. It is a very important part of the argument.
Yes, it is. Good question, Glenn. Any other questions?
I think we have one that's coming, a couple more that are coming in here. We just hope, hi, there's...
Okay. Here I see one from Sylvester Fadal. Is it arguably certain that the health care bill would pass in view of the number of votes required in the Senate? If yes, how significant of an impact would it have on the future of retirement?
Well, I think that is the question of the day in Washington. Can this health care bill pass? We thought that it had been stymied in the House of Representatives. It looked like they weren't going to, after you saw the stunning pulling the bill from the House floor March 24th, the Speaker, announced that they were done with this. The President said they were done with this, and then they came back. And they did pass the bill in the House by 4 votes. So I think, given that history, it is, highly questionable how they're going to move forward, what the path forward is. But I would say that they are meeting daily. Majority Leader Mitch McConnell has a 14 Republican member senators meeting to figure out how they make some significant changes to the House legislation so that it can pass in the Senate. And I think if they want to use this budget process that we discussed, it allows them to only have to have a 51-vote majority. My feeling is that they will find a way. We didn't think they would, but I am beginning to shift to believe that they will. I would like to say otherwise, but I think that it may happen. In terms of the impact on retirement, we see massive $880 billion in cuts to the Medicaid program through 10 years. So if anybody is looking at relying on Medicaid, and as we know, Medicaid, not Medicare, provides long-term care in this country, and many people, middle-class people, working-class people, lots of people, even people with a lot more money who never anticipated nursing home bills, long-term care bills, have relied on the Medicaid program. And so that would be impacted significantly. And then you're looking at the impact on the insurance markets, whether or not states would opt, as allowed under the House bill, to for insurance companies to increase premiums for those with pre-existing conditions. So all of those kinds of efforts certainly could affect people's status in retirement. John, did you want to add something?
I was just add that the indications are that premiums would go up for people between the ages of 50 and 65 under the American Health Care Act that replaces the Affordable Care Act. So to the extent that early retirees were not covered by health insurance provided by their employers, they might see higher premiums in retirement, and therefore, of course, the need for more retirement security to support those premiums.
Thank you for that response, Susan and John. I have another question from Tim Coyne. What are other entities, service providers, Chamber of Commerce, financial industry, et cetera, doing regarding these proposals and their impact on people's ability to save for retirement?
We've been in touch with a number of these groups. Everybody is in the process of, I think, preparing. You have to remember that an entity like the Chamber of Commerce, of course, has a lot of other tax-related interests out there. So they are focused on, large part on the bigger picture of tax reform. We are actually meeting with, later today, the private defined contribution groups and talking with them about whether or not we can join forces and work together going forward. We've been to the Hill with a number of service providers and their lobbyists and private interests regarding the consolidation issue. And I think people are still gathering information. I've talked to a number of individuals that represent interests here in Washington about this Rothification idea. And although you're hearing a lot of concern about it, I think people are doing, as NAGDA is, some research regarding what the impact on their clients or their associations or their interests would be. And everybody's, all eyes on the health care bill, because the more time you have to gather information before tax reform really takes off, I think you try to use that wisely.
Thank you. Thank you, Susan. Any other questions that people would like to pose while we have our legislative experts here with us? Okay. All right, everyone. Well, it looks like we're going to finish up a little bit early, and I want to thank you for joining us today. It's time to wrap up the webinar, and we look forward to seeing your survey responses come in and encourage you to reach out with any questions. And we may be providing a template letter for organizations to use to contact their members of Congress. That's something that came up just in this format, and we'll give some attention to that and decide how to go forward with that. But I want to thank you very much for participating, and especially big thank you to Susan White and John Shiner for sharing their knowledge with us. Thanks, everybody. Have a great rest of your day. Bye-bye.